So students, today we are going to talk about a question that I have picked up from chapter number 2. So the problem is PF 229A and the page number is F246. That's the page number. And we're going to talk about these transactions. So today we are talking about journalizing transactions, posting journal entries to T accounts, and preparing a trial balance for the following transaction. So as you have already learned in chapter number 2, we are using two operators. One is called debit and the other is called credit to journalize these transactions. So what does debit means and what does credit means? So in a nutshell, in a very simple way, we can say when there is an increase in an asset and expense account, we debited. All right. So what's an asset account? Asset account, for example, cash. So if the cash is coming in the business, that means cash is going up, we will debit the cash. If increase in expense, for example, you hired somebody and you are paying them salary, that means salary expense is going up and you will have to debit that expense. So for example, as an example, I'm putting salary over here. All right. And when there is an increase in a liability account, equity account, and revenue account, we credited it. So what does it mean? A liability is going up. For example, in the previous example, we talked about a business is buying a computer, but they do not have the cash. So they gave a note or a promise, or call it a promissory note to the business where they are getting their computer. And they are saying that I will pay you later. So I acknowledge. Liability is a way of acknowledging what you owe to others. So for example, you purchase a computer, you don't have the cash, and you will pay them say in 3 months. So that means you have a notes payable. So a liability example is notes payable or accounts payable. Equity accounts, as we have discussed, equity accounts are like common stock, retained earnings. So these are accounts, every time they go, you have to credit them. And a revenue account, whether it's a service revenue that you are selling a service like as a doctor, lawyer, or accountant, or you are selling a product such as a TV, a furniture, automobile. So you have a revenue account. So every time you make more sales, you credit. So every time you make more sales, the sales bring increases the revenue, and you credit the revenue. So what if an asset account is decreased or expense account is decreased? Expense account usually does not decrease, but asset account do decrease. When a cash is going out of a business, we credit that cash. So when there is a decrease in an asset account, we credit it. For example, payment of cash. So why do we make a payment of cash? Cash is going down. such as you are paying for utilities, you are paying for salaries, you paying for rent. So every time cash is going out, you will credit the cash. So do we also, so when there is a decrease in liability, revenue, and equity account, we debit. So for example, you have a liability, accounts payable or notes payable. If you have paid part of it or all of it, you will debit it. In revenue, the only thing you will debit is like a kind of a discount you have provided. We will talk about in later chapters. In equity account, the one thing that you debit is for two things, one for dividend and one for treasury stock. And we will talk about treasury stocks in our fourth module as well. So we will continue here our solution for this this question in a minute. Where did I put my papers? All right, here is my paper. So let's go to the question first. So they have given you these transactions. So Vince York, the person, practices medicine. So it's a doctor's office in Vince, New York, MD. That's the title of the business. So the name of the business is Vince York, MD. And during July, in the month of July, the medical practice completed the following transactions. So these are transactions, all these transactions from July 1 to July 31st. For example, York contributed $63,000 cash to the business in exchange for common stock. So this is usually an initial step. When you are opening a business, you set aside from your personal account to a business account that is under business name. For example, here Vince York MD is the name of the business. So you open it, and business in return give you shares or common stocks. So stock and share are interchangeable. So either you can use common stocks or shares. These are usually interchangeably. And then in July 5, they paid monthly rent on medical equipment of $510. So most of our service providers, such as accountants, lawyers, and doctors, they rent their equipment. They don't outright buy it, but they usually rent it. So you have to pay rent. And paid $23,000 cash to purchase land to be used in operations. So they purchase a land. Purchase office supplies on account. On account is an important word. It means you are not paying cash now, but will pay later in the future. All right, so that's a word is important because you will see this word in your homework and quizzes and exam question. Then they have borrowed $22,000 from the bank for business use, paid $1,100 on account. Whatever they have purchased in the past on account, a liability. Then the business received a bill for advertising in the daily newspaper to be paid in August, $240. So they're receiving a bill. Revenues earned during the month include $6,400 cash and $6,000 on account. Means the patients give this doctor $6,400 cash and they promise to pay later. On account here means on account over here when you as a business is buying something, it's a liability that you owe, and when you are giving customers service on account or on credit, it's account receivable. So its liability is an accounts payable and account receivable is an asset. And then paid employer salaries, office rent, utilities. And then business received $1,120 for medical screening service to be performed next month. So they are receiving cash in advance and they will provide the service later on. and they also paid cash dividends of $7,200. So now let's see what is the requirement. The requirement is the journalize each transaction. Explanations are not required. So we're going to journalize each transaction. So I'm going to read this transaction one more time, and I'm going to journalize this transaction by using the debits and credit operator instead of using the accounting equation that we use in chapter number 1. All right, so York contributed $63,000 to the cash in exchange. So suppose this is a business. All right, so business is receiving $63,000 cash, and in return the business is giving back to the shareholders $63,000 worth of common stock. All right, so it is a way of business is telling the reader of this information that initially doctor put down $63,000 in this business, invested $63,000 in the business, and the business in return gave the doctor $63,000 of common stock for this business. So as you can see, the cash is coming into the business, so cash is increasing. So what we're going to do, cash is an asset, as we know, so asset is going up, so we're going to say debit cash $63,000, and we're going to credit common stock for $63,000. So common stock is an equity account. So when an equity account is going up, we are going to get we're going to credit that and the cash account. So now we also have to make sure that we put a date here. The date on this one is July 1, and usually at the bottom of this there is a note where you can put why this transaction happens. So you can say in English, initial investment by the shareholders. That should give the reader of the financial statement of this transaction, they say, okay, so you don't have to do it. I'm just telling you it's a good practice when you do that. All right, let's move to the second transaction. Here on July 5th, so I'm going to put a date, July 5th, paid monthly rent on medical equipment $510. So what we are seeing here in this transaction, the cash is going down by an amount of $510. That means an asset is going down. So what we need to do, when the cash goes up, we debit. When the cash goes down, we credit. So we're going to say credit cash $510. Now somebody might ask you a question, why this cash of $510 is going out of the business, or why you are giving someone $510 from this business. So you will say, because we have equipment rent expense of $510. What you are saying here, that this business used someone's medical equipment in order to do this business, and they are paying $510 cash as in lieu of rent. So that is what you're showing. So you can put a note here, paid rent for medical equipment. All right, so in this case you debit the expense. That means expense is going up, so every time expense goes up you do the debit. Every time cash or asset is going down, since it's going down here because you're paying the $510 going out of the business, so you will be crediting the cash. Now we will move to the third transaction. It says paid $23,000 cash to purchase a land to be used in operation. So what we are saying, on July 9, this business paid $23,000 cash. So the cash in this scenario, in this scenario is going down by $23,000. So somebody might ask a question, why we are giving up this much cash? So the answer is because we are purchasing a land. Land is also an asset. So what we are doing, we are exchanging one asset with another asset. So we are giving up cash, $23,000. And what we are receiving, we are getting a piece of land for the same amount, $23,000. So you notice that land is also an asset and cash is also an asset. So in this scenario, you are getting the land but giving up the cash. So one asset is going up, land means land is coming into the business, and another asset, cash, is going down, so we are crediting it. Okay. Now let's see the next transaction, which happens on July 10. And what we are doing in this transaction on July 10, we are purchasing office supply on account for $1,600. So we call Staples, for example, this business called Staples, and they said, we looking for office supplies and we need the following office supplies. They told them, your office supplies is ready. You have to pay $1,600 to pick it up. And they say, well, deliver to my office and I will pay you later. And they say, okay, fine, we will let you pay later. A lot of business transactions happens every day based on a promise that the buyer will pay at a later date. So in this transaction, we have, it happens on the July 10th. So date is July 10. And in this transactions, we are receiving an asset is called office supplies for $1,600. So that means we receive this office supplies of $1,600. So office supplies as an asset is going up. So this is an asset. So we're going to debit it because the asset is going up. So office supplies are going up by $1,600. Now, when you purchase something, you pay them via cash. But in this scenario, they are buying this on account. They are not paying cash. And they promising they will pay later a cash. So that means a liability, say accounts payable, is going up by $1,600. So in this case, asset is going up, so you debit it. Credit is going up, you debit it. So we can put a note here, office supplies purchased on account. That's it. That's all you have to say. For example, I forgot over here, note in this one, purchase land for $23,000. Okay. So this is the fourth account. This is how we are going to make sure we do that. All right. So now we're going to move to the next transaction. In the next transaction, the business on July 19 borrowing $22,000 from the bank for business use. Last time we discussed, when we have a personal transaction, we do not mix it with a business. That's the idea behind business entity, is that we keep our business and personal lives separate. All right. So in this transaction, we are borrowing. So what is coming into the business? Cash of $22,000 is coming into the business. That means the existing cash is going up by $22,000. So we can say the cash is going up by $22,000. And what we are giving them, since we are borrowing, so we basically giving them a promissory note. We are giving them, telling the bank, hey, I need this money, $22,000 today, and I will pay you at a later date. Of course, they are going to charge some interest. We are not discussing in this example, but we will discuss that in later chapters how we calculate interest and how we journalize it. So we are giving them a notes payable. A notes payable is a liability. So in this case, your asset cash is going up and you have a liability is also going up. So what you're going to do is you're going to say debit cash $22,000, and you're also going to credit notes payable for $22,000. And when you write a note, you just say borrowed $22,000 from bank, and then usually you put continue this, say for 3 months, 6 months, 7 months, 8 months, 9 months, whatever the duration. And you're also going to note here at 5%, 6%, whatever the interest that you are paying on it. All right, let's move to July 22. On this date, we paid $1,100 on account. You notice that in a previous transaction, when we purchased our office supplies for $1,600, we didn't pay them any cash. We promised them we will pay later this $1,600. So we purchased this on July 10th. Now comes July 22, and we are saying that we are going to pay you $1,100. So what is going out of the business? The business is giving up $1,100 of cash. So cash and asset is going down by $1,100, and by giving this $1,100, it's also going to reduce our liability by $1,100. So what we're going to do is we're going to credit cash $1,100, and we're going to debit the accounts payable for $1,100 as well. So what we're going to put here in the notes, so our accounts payable is going down by $1,100, and we're going to say paid $1,100 for accounts payable. Means we have reduced our liability of $1,600 to by paying $1,100. So now we have left only owe them $500. All right, so let's move to the next transaction. The business received a bill for advertising in the daily newspaper. Let me bring it down. The business received a bill for advertising in the daily newspaper to be paid in August, $240. So this business used some advertising agency to advertise their medical practice, and they receive on August 28 a bill that says you owe advertising agency $240, say you need to pay, but the bill is due, say, in August, sometime in August. So on date July 28, we received a bill. So when you receive a bill means you have already used someone's service. So something that has already been used and cannot be used again is called expense. So for example, you have a paper towel in your kitchen. You took out the paper towel, you wash your hands, wipe your hands, or wipe the kitchen area, and then you throw it. Now you're not going to use that tissue paper. So the tissue paper that you have used and throw it is an expense. But whatever leftover tissue paper you already have in your cabinet, it will still be an asset, because it is an asset because it's going to provide you future benefit. Means today you use part of the paper towel, and tomorrow or day after tomorrow you will use some of it again. So something that can be used again or can provide a future benefit is an asset. Just like someone's good looks or height or wealth or education is an asset for them. All right. So in this case, we have received a bill for advertising. So it's an expense. So we're going to debit advertising expense for $240. Since we are not paying anything right now, so we just simply saying advertising payable. So we know that is a liability that we have to pay at a later date. So we call it advertising payable, which we will pay later, because this expense is related to advertising, or this liability is related to advertising. So it could be advertising payable, salary payable, rent payable, utilities payable. Anything that ends with the word payable, it's almost always a liability that a business has to pay at a later date because they owe this much money to the other people. So we have advertising expense and we have the credit. So note, you could just simply say received advertising bill. All right, let's see for the next transaction. So now we are on 31st and it says revenues earned during the month include $6,400 cash and $6,000 on account. So this account means the customer, your patients, your client owes you $6,000 because they told you that, hey, provide me the service today, I will pay you later. So what we have received in this transaction, so we have to pay date 7/31, I believe, yes. So we have received cash of $6,400 and we have an account receivable because it's on account, $6,000. And why do we have this cash and why do we people promise to give us money later? Because we have provided them the services they requested from us. So therefore your service revenue is going up by the total of 6,400 plus 6,000, so it's 12,400. So this doctor may provide a service to his customer for $12,400, and he receives $6,400 in cash and a promise from the clients for $6,000 they will pay at a later date. All right, let's see what else they did on July 31st. On July 31st, they paid employer salaries for $2,200, rent for $1,900, and utilities for $560. So all of these are expenses. So what we're going to say, date 7/31, we're going to say debit salary expense because this is the money going to our employees. The employees has worked. Then we have another expense, it's called our rent expense. Then we have another expense called utilities. So the salaries expense is $2,200. $2,200. And the rent expense is $1,900, and the utilities expense is $560. And according to this transaction, they are saying that paid. So when they use the word paid, it almost always means that the business has paid using cash. So that means this much cash is going down. If we do the total of these two, we come across a total of $4,640. So the cash is going down, but our expenses are up. So these three expenses, and we had to shell out $4,660. Okay, let's see if we have another transaction. This one, it's also July 31st. The business received $1,120 for medical screening services to be performed next month. So on this July 31st, we are receiving cash. The cash is coming in before we provide the service. So when the cash is coming in, so we're going to say debit cash of 1,120. So the cash is up, but what we are going to credit, we have received the cash, but we have not provided the service. That means once the business receives the cash from the customer, the business is obligated to provide a service at a later date. So that means next month. So you have not, so this is not your revenue. This is not your service revenue because you haven't provided the service yet. So when a service is not provided, we call it unearned revenue, means you have not worked for this revenue yet. And we call, and it's the same amount, 1,120. And an unearned revenue is a liability. Means you owe your customers or your patient $1,120 worth of service, which you will provide. Once you provide that service, this unearned revenue becomes a earned revenue, which we will discuss in next chapter. But this is a very important concept. You will definitely going to have question about unearned revenue in your upcoming first exam and final exam, and in the first 4 chapters homework and quizzes. So make sure you have a good handle on, a good understanding of unearned revenue. All right, let's see what is the last one. The last one also happens on July 31st. Paid cash dividends to the dividends of 7,000. So business has paid its shareholders dividend. All right. So what is going out of the business? Cash is going out of the business. Every time when you pay dividend, cash goes out. So your cash is going out for 7,200. So your cash is down. But what is, you need to debit because your dividend amount is up. So dividend of 7,200. All right. So this is where we stand with these transactions. All right, let's see what is the second requirement we have. The second requirement we have here is the post the journal entries to the T accounts. So a T account, so this is requirement number 2. So we have to put a T account. So T account looks like this. It's like a T. You have cash on this side, the name of the account. So this is cash or name of account goes in the middle. All right. A debit on this side and a credit on this side. So debit is always on the left side in a T account, and a credit is always on the right hand side. Now what we will go do this, in order to accomplish this, we have to go back to our transactions that we have just completed. So in the first transaction, we have cash. The business received $63,000 of cash. So here in the cash, $63,000, you are going to post it. So on the debit side is going to be $63,000. And we'll talk about the common stock in a minute. All right. The next thing, if we go to the next transaction, we paid cash of $510 for the medical equipment. Means this cash was credited. As you can see, the cash was credited. So I am going to put this $510 on the credit side. Okay. Now in the next transaction, which happens on July 9th, again cash is involved. We purchased the land for $23,000 cash. So the cash is going again, and you notice the cash is on the credit side. So we're going to put 23,000 on the credit side over here. In the next transaction, when we purchased office supplies, there was no cash involved. So let's move to the next one. Here, on July 19, we borrowed $22,000 from the bank. And what we give the bank? A notes payable, a promissory note that will pay you later. So $22,000 came, and you can see that I put a debit. So they will be going on the debit side of $22,000. All right. The next thing we're going to do is on July 22, we paid $1,100 for the accounts payable, right? The supplies that we have purchased. So we credit our $1,100 that we paid. So we're going to put this on the credit side, $1,100 here. Okay, let's move to the next one. On July 28th, we receive an advertising bill, but we have a payable because we didn't pay any cash. On July 31 again, we have credited our service revenue for $12,400, out of which $6,400 of cash. So we're going to put $6,400 over here as a debit. Okay. The next thing we're going to do is on July 31st, we pay a cash of $4,660, and we paid it for salary expense, rent expense, and utility expense. So we have paid, so we credit this cash for $4,660. So we're going to do $4,660. Okay, let's move to the next transaction. In the next transaction, we are receiving a cash from customers for $1,120. The service we have not provided, but we receive a cash, so we are going to add $1,120. And in the last transaction, we paid a dividend, so cash going out by $7,200. All right, so that's give us a balance. So what I would like you to do in the beginning as a practice, that first you add everything on the debit side. So 63,000 plus 22,000 plus 6,400 plus 1120. So you have $92,520 on this side, and then you add everything on the credit side. 510 plus 23,000, 1,100, 4,660, and 7,200, and you have $36,470. All right. So what you need to do, you have 92,520, and you subtract which side is bigger. So the debit side is bigger, so you take the debit side and you subtract credit from there. So minus 92,520, and the answer is 56,050. So I just want to let you know here that when it comes to cash, almost always 99.9% of the time, every business ending balance would be 50. So what is this is the ending balance of cash as of July 31st. All right. So this is the ending balance of $56,050. Now we are going to work on other transactions. So when we were working on July 1st, we received this $63,000 cash, but what we gave up was a common stock for $63,000. So we have to have an account for common stock. Debit on this side, credit on this side. Always have a credit balance because it's an equity account. So we're going to put $63,000 over here. Okay. Now in the next transaction, we have, what was the second transaction? Paid rent on monthly equipment or medical equipment for $510. So we have a rent expense, so we have to have an account here, rent expense. Credit on this side, debit on this side, and we have a rent expense of $510. All right, let's move to the next transaction. In the third transaction, we paid $23,000 cash to purchase the land to be used in operation. All right, so we have to have a separate account for land. So we're going to create a land account. It's an asset, so it's a debit side, credit side, and the land we have received is for $23,000. All right, so that is a land account. All right, let's move to the next transaction. In the next transaction, we have borrowed $22,000 from the bank. So we're going to open another account. It's called notes payable, debit and credit, and we owe I think I missed it incorrectly. Borrowed $22,000, so it's not 23, it's 22,000. Is it 22 or 23? 22,000. All right, so we have a $22,000 notes payable that we will pay at a later date. All right, so next move to paid $1,100 on account. So what happened when we purchase supplies, we have an account called accounts payable. So our accounts payable was $1,600 when we purchased power office supplies. Now we have paid $1,100. So that means we have a $500 balance that this business is still owed to whoever sold them office supplies. All right, so let's go to a next transaction. Business received a bill for advertising in the daily newspaper to be paid in August. So we haven't paid anything, but we can make a small account here, advertising expense, and it's debit and credit, and the expense is $240. Since we haven't paid it yet, so it will give us another account, advertising payable. Advertising payable, that means we owe these advertiser $240. All right, let's move to the next transaction. In this transaction, revenue earned during the month includes $6,400 cash and $6,000 on account, which is account receivable. So we have to make another account. It's called account receivable, which is debit, credit, and we have here $6,000 that we have to receive from the customers. All right, the next transaction. Paid employees, salaries, office rent, and utilities. So we will be making a few more accounts: office, salaries, debit, and credit. So it's a expense account, so it will remain here, $2,200. We will make another account, office rent, debit and credit, for a $1,900, and then we will make office utilities, or simply utilities, for $560. Right. So we make these accounts. Now, the business receive 1,100 for medical screening services to be performed next month. So that means we have a liability here, unearned revenue, which is a liability. So it's credit here, debit on this side, and we have $1,120 under unearned revenue because we haven't provided the service. We receive the cash, we'll provide the service at a later date. Okay. In the last one, we paid dividend for, so we're going to make another account, dividend, and we paid $7,200. Now let's go over one of these accounts. So the first account is a cash account. Cash is an asset. I'm just putting asset. You can see the common stock is an equity account. Rent expense is a income statement account. Okay, so let me put it this way here on this page. Income, so revenue, expense, gains, and losses are income statement accounts, and these accounts are called temporary accounts. Asset, liabilities, and equity are balance sheet accounts. These accounts are called permanent account. Okay, so why temporary and why permanent? These accounts are permanent because their ending balance becomes the beginning balance for the next period. It could be next month, next day, next week, next quarter, or next year. So this $56,050, when we create another cash account, or it will be, so on August 1st, this would be a beginning balance for this account. Why we call temporary accounts? Because these accounts closed into retained earnings, like I'm going to show you in a minute. Retained earnings. All right, so that's why, and these are called permanent accounts because their balance shifts, so their ending balance becomes the beginning balance of the next period. All right, so let's see what other things they want us to do. Label balance of each account balance. All right, that's very good. So if we look over here, the balance doesn't change because this is still 63,000. Rent expense for medical equipment is still $510. Land is still for $23,000. Advertising expense is still $240 this month, and advertising payable is still $240 because you haven't paid anything yet. Notes balance is going to be $22,000 because you haven't paid off anything, and the ending balance for accounts payable is $500. So next period, your accounts payable beginning balance would be $500. So this is a liability account. Payable is a liability account. Land is an asset account. Expense belongs to income statement. This expense belongs to income statement. And account receivable, because we haven't received anything from our customers, so it's $6,000, and this is an asset account. Office salaries is an expense since we didn't pay anything, so the ending balance would be 2,200. Office rent, we haven't paid anything, so it will be 1,900. Utilities will still be 560 ending balance. Unearned revenue, you still owe them 1,120. And dividend, since you paid only one dividend, the ending balance is $7,200. And unearned revenue, it's a liability. There may be a question in the exam, they ask you that unearned revenue is a liability. All right, let's see what else we have to do in this question. Prepare the trial balance of this firm. All right, so we will prepare the trial balance. So what is a trial balance? A trial balance looks like this. You have debit on this side and you have a credit on this side. You always start listing all the asset account first, and then you list liability accounts, then you list equity accounts, then you list revenue, and then you list expense. And both sides, all debits should be equal to all credits, and we're going to see it in a minute. All right, so let's see what accounts we have over here. Sorry, I didn't mean over here. That's the account name. So we have a debit, and then we have another column. It's for debit over here and a credit on this side. So asset, what asset accounts we have? The first thing we have is cash. So we will put cash. And how much cash we have is 56,050. The next account that goes over here is another asset account, account receivable. So we have account receivable, and the ending balance is 6,000. So we will put the $6,000 over here. All right. Do we have any other asset account? Let's go over here. I believe the one asset account that we did not put here is office supplies. So let's put office supplies. And the office supplies we received was worth $1,600. So we do not know how much we have used or how much is still available, but we believe it's $1,600 because that information is not provided to us. So we put office supplies of $1,600. And then we have land. The land is we purchased for $23,000. So we put 23,000 over here. Now we don't have any more asset accounts, so we start with liability accounts. The liability accounts we have is accounts payable, and as you see, this accounts payable balance is $500. So we put $500. It's on the credit side, so it will go on the credit side here as well. Now besides this $500, we also have advertising payable. So we will put advertising payable, and it is $240. And the next is we have unearned revenue is also a liability for $1,120. So you notice I put $500 for accounts payable, $240 for advertising payable, and unearned revenue of $1,120. Okay, do we have anything else? Let's see. Over here we have notes payable, so we're going to put notes payable of $22,000. Okay. The next we have to put is equity. So under equity we have common stock, and here is our common stock, 63 on the credit side. So we will put on the credit side 63,000. Then we have dividends. Dividend is over here, which is 7,200, but it's, oh, sorry, it's on the debit side. So we have dividend on the debit side, 7,200. Okay, now we're going to have a revenue account. And how much revenue do we have? Let's move over here. We didn't make a revenue account. Oops. Let's make a revenue account here. And we have given here in this scenario, revenues earned during the month include $6,400 and $6,000 on the account. So it's a $12,400. It's on the credit side. So that will go over here. And when we take it to our trial balance, we will put revenue $12,400. Okay, what else we need? Now we need all the expense, so that revenue is service revenue. Now we're going to put expense account. What expense do we have? We have salary, advertising expense. So we have advertising for $240. Then we have salaries for the salaries was 2,200. Then we have rent, office rent for 1,900. And then we have utilities for 560. And we have a medical equipment rent that we paid the medical equipment, where we have a medical equipment paid monthly rent on medical equipment $510. So this is $510. So you notice over here that ending balance of all the asset accounts are debit, so we put in the debit. All the liabilities account has an ending balance credit, so we put on the credit side. Common stock has a credit balance, dividend has a debit balance, revenue always have a credit balance, and all the expense. So what we're going to do here is we're going to add and we're going to total. So we're going to do is we add all the debit first and then we add all the credit. All right, so we start with 56,050, 6,000, 1600, 23,000, and then 7,200, then 240, 2200, 1900, 560, and 510. So it's 99,260. Okay. Now let's check on the credit side. 500, 500, 240, 1120, 22,000, 63,000, 12,400, 99,260. Okay, you must be thinking that in real life this always turns out to be a clear like whistle. All the debits are credit are equal to all the credit. It is not the case. Majority of the time, 99% of the time, when businesses prepare a trial balance, when transferring all the data from the T accounts to a trial balance, these two amounts are never equal. And we have to make an adjusted trial balance. We will be talking about the adjusted trial balance most likely in the next chapter. So if you have any question regarding this video, please feel free to contact me via email or show up during my office hours, and we will go through it if you have not understand anything or you need more clarification on any of these things. Okay, thank you. And please do provide your feedback. Thanks.